Hi there. Okay, so what we're going to do is we're going to go through an example of how we help clients who have existing 401k plans, 403b plans, and 457 plans. If you're looking at this video, watching this video, it's because you have one of these plans. So let's go through here and we'll show you what we're able to do and help our clients. Okay. Here's our disclosures. Very informative and important to know. Terra Firma is a financial consultant, business and financial consultant firm. We provide advice based on information and information only. Here we are not providing any investment advice. So the plight of the investor. Well, Dalbar did a study. They do an annual study, as you can see, from 1987 to 2016. And what they're doing is comparing the S&P 500, which we use as our benchmark for performance, as well as Barclays Aggregate Bond Index, which is the benchmark for bonds. And if you can see here, what it shows is the chart shows the study revealed that the S&P 500 returned an average of 10.16%. While equity investors returned over that same period was just 3.98%, which is a difference of 6.18% annually. Now, based on the Barclays, you can see that the average fixed index investor fared no better. The Barclays averaged 6.34, where the investor averaged 0.57. So that's a difference of 5.77. If we were to combine those as an average, it's a pretty significant change. Now, why does this happen? Why is there such a huge discrepancy when we're looking at investment returns? Well, the main thing is because emotions drive investors to buy the latest hot fund. So you got the Money Magazine, or you got your Wall Street Journal and they had said something in there and it piqued your interest, and so you tend to sell funds and writing to the bottom. Typically what average investors do is they buy high and sell low, which is the opposite of what we're always taught, right? We're taught to buy low and sell high. And we do the same thing when we go to, let's say, like Macy's to buy clothes. We always buy things when they're on sale. But the interesting thing is when it comes to our retirement money, we tend to do the opposite. And that's because the emotions drive us. Buying on greed and selling on fear might satisfy your short-term emotional needs, which sometimes it does. After you sell, you're like, ooh, okay, everything's fine. But what ends up happening is that lack of discipline compromises your long-term objectives. So there's 7 common mistakes that mess up your retirement plan, your 401k plan. People don't sign up. They don't get the full company match. They take too much risk, take too little risk. They follow the crowd, they may take out loans, and they cash it out. So working with an investor, an investment advisor, could possibly help eliminate and alleviate some of these. So changes to your plans. In the Pension Act of 2006, there were more investment options. Access to investment advice was provided. Risk managed portfolios. Broker window options, we'll talk about that, and fiduciary accountability for plan vendors, sponsors, employers. This is significant. Notice it is bolded here, fiduciary accountability. And we're finding that a lot of vendors, sponsors, and employers are not necessarily staying up with the fiduciary accountability rules. So let's take a look at a Joe client retirement account. Okay, he could have a 401k, 401a, 403b, 457. It doesn't matter. Those are the IRS codes for those retirement type plans. So here's what you typically have with a core investment options in one of these plans. You have lifestyle or target date funds. You have fixed income or real estate, money market funds, value growth and global funds, large, mid cap, small cap funds. The plan sponsor typically chooses which ones they want. You do not get to choose those. You get to choose from the ones the plan sponsor provides. So let's say there's 9 or 10 options. You get to choose out of those 10 options. Okay, so what we do is we come in and most of the time there's a self-directed brokerage account. We would be able to help you figure out if your plan has that by contacting us, and we'll give you instructions on how to figure that out. So what we do is in that brokerage account, we provide our 401k pre-retirement solutions. Well, what's this mean? Well, we right off the bat, you have access to your retirement account. You give us access. It just doesn't happen. You don't snap your fingers. You give us access. And the first thing we do is we do what's called a risk analysis. We give you a score based on what type of risk you're willing to take within your portfolio, meaning how much are you willing to lose? So in Joe Client's situation, his score was 66.12, and his profile is a moderate investor. So what that means is that he's comfortable with about 11.22% rate of return and a risk of about 25%. Now you may be different. Your score may be higher, may be lower. That will be based on your answers to the questionnaire that we would provide and help walk you through. So let's say his total account value is $250,000. Well, we go based on his risk tolerance of moderate. He's comfortable and okay with losing $62,500. Now, if you are not comfortable with that, or you are much more comfortable with that and you're willing to risk more, then we can make the adjustments down here. That's perfectly fine. But what we want to do is have a benchmark or a baseline of what your risk score is. Most people, what we find, don't even know what that is. They just choose funds based on what they think sounds good or what they heard somewhere, and they may be either taking too much risk or, like we saw in the common mistakes, not taking enough risk, and they're not getting a decent return. And taking advantage of the opportunities that are out there. So these are very, very important situations and things to look at as we're going through this advice. Now, what clients really want is help. You want somebody to help you figure out what your portfolio should be, manage your portfolio. Typically, we find that people aren't getting this advice in their 401k plan because most advisors who put the plans in place, the vendors who put the plans in place, that's what their job is, or what their focus is putting plans in place, not necessarily helping those that are participating like yourself. So we'll step in, we'll help you as a participant, and we'll give you that advice. So the objective of retirement plan accounts is to provide participants, you, with investment options that are more often designed for growth and accumulation rather than wealth preservation. Well, that depends on what your risk tolerance is. You may be at a certain point where you want to preserve your wealth, but you do want it to grow at the same time. So your priorities are different. Well, that's what we can help you with and decide on where you fit into your plan and your plan fits into your goals. The goal is to help you, the investor, save and create an asset base for income during retirement. That's the whole point of this. Now, the industry trend tends to show fewer core options, which typically plan sponsors, companies, put in fewer options because they typically put in what's required, or target dated funds. Now, they're not investment advisors, right? And the 401k plan vendor is there to put a 401k plan in place. He does not know what each participant's goals are, what their needs are. So your core options are pre-selected investment choices made by the employer and not necessarily based on your goals. And so what typically happens is you take control of your retirement by giving us the self-directed option. And again, like I said, we can walk you through that and show you if your plan has that ability within your existing structure. Now, here's some examples of companies that have this, what we call a brokerage window, a brokerage link. So these are all very familiar companies. Now, your company may not be on this list, but that doesn't mean that your company does not have the same link. You may still do. That's why I indicated earlier, reach out to us. Give us a call. Let us walk you through and show you how to find that out. It's very, very simple to do. So why does advice matter? Well, recent studies emphasize the importance of client-advisor conversations. Well, what's important about this? Well, advisors can actually add a 3% to your return. Now, that's done by a study by Vanguard. Okay, so now Vanguard has been made popular over the last couple decades based on saying, hey, do it yourself. Fees are lower. But then they come out with a study saying, oh, advisors can add an extra 3% to clients' net returns. And retirement savers, now it says net returns. That's actually after the fees and costs of the advisor and the plan. So that's pretty significant. That's an additional 3%. let's see here. Retirement savers who sought investment advice enjoy a median annual return of almost 3% higher than those who didn't, even after fees they paid for that advice. Pretty significant, isn't it? It's almost contradictory to what Vanguard has been preaching. And so this study proves, and I give Vanguard credit for putting this study out and actually giving the results. So that's pretty significant. Now, where's this extra 3% come into? Well, here at Effective Behavioral Coach. So we act as an advisor, we act as a behavioral coach. So if the market's really volatile, like it has been in certain times, you can call and freak out. You're on the roof. We'll talk you off the roof. We'll remind you of your goals. Or maybe it's a good time to make some adjustments to the plan as well. But that's based on the conversations. That's what the behavioral coach kind of focus does. That's up to 1.5%. Now, applying asset allocation, specific allocating your assets, changing and diversifying those assets can add almost a point, 3/4 of a point. Cost-effective investments. So looking also at fees, all right? Not just the advisor's fees, but the actual plan fees. Now, managing allocations and rebalancing is extremely important. Just knowing how to and when to allocate and rebalance adds a 1/3 of a point. So you add that to the asset allocation, now you're over a full point. And managing spending strategy. So figuring out when you finally do hit retirement, how do we spend out? How do we distribute? How do we create an income from this? And that actually adds almost a whole % to the plan as well. So without advice, portfolio people they suffer from inappropriate risk levels like we talked about. Sometimes they try to time the markets. That's a huge mistake. And just misunderstanding risk and market volatility. And this is back to the behavioral coaching. So that kind of gives you some thoughts to think about. Now, people who sought help earned 3% more based on that study. They continue. Retirement savers who sought investment advice through their 401k plan enjoy median annual return of almost 3% higher than those who didn't, even after the fees they paid for the advice. Okay, so we're kind of beating this horse, aren't we? Now, inappropriate risk levels and inefficient portfolios, these are extremely important. And misunderstanding your risks and market volatility, what that means to you, and how these play into your overall return. Because remember, what we're doing is trying to save a pool of money for future income when you decide to retire from what you're doing. Now, here's that Vanguard study. So basically what it comes down to is advisors help increase your wealth, reduce your risk, impact on savings and rates, and reallocation of company stock and participants just basically having a more comfort level of what's going on with their money. Now, what happens with target dated funds versus personal advice is a lot of times the questions that ask is, do you want an investment that was designed for millions of participants, or do you want something that's designed for you? Well, everybody that I've asked that question to says, well, I want some designed for me. Exactly, and that's what the personal advice and what we do. Versus target dated funds just is for literally the masses. So we create your personal retirement date portfolio with from our trusted advisors. We coordinate all your assets and define all your goals and objectives. A comprehensive investment management and cohesive financial planning. We can also include your other assets outside of your retirement plan to work in conjunction with your retirement plan. So that's something that we can discuss on a one-on-one basis as well. So how's the evolution of the diversification? How did this whole thing work out? Okay, so there's basically 3 legs to the stool. And what I mean by 3 legs to the stool, if you envision a stool has 3 legs, if you took one of those legs away, the stool would fall over. Obviously, if you took 2 legs away, the stool would fall over. So you really need all 3, and the ability to be flexible to go in and out of each of those 3. So the first strategy is market movement. It's strategic and traditional management style. We look at core positioning, we seek pure and full participation, and effectively manage longevity and inflation risk. Here's some of the investment advisors that we work with in this area: Wilshire, Ivy, MFS, Ward, Loring Ward. You may not have heard of these, you may have. Either way, these guys are perfect within these areas. Now, does that mean that these guys will always be here? No, our job is to review them and grade them just like you are in your employment or or like you do with your employees. The second strategy is a dynamic asset allocation. What this does is it's an active and tactical management style that seeks to productive risk adjustment returns. So what we do is we look at how the market's performing, and we make adjustments actively based on certain indicators that the market's telling us. Asset class flexibility to actively adjust portfolios and change global market conditions. Adjust risks in portfolios while optimistically allocating to attractive asset classes. So you've heard of PIMCO, I'm sure. Meadner, most people haven't heard of, and then the Pacific Financial Group also. These guys are perfect within this area as well. Now, strategy 3 is active alternative allocations. These strategies are designed to provide a source of risk and return that is independent of overall stock and bond market movements. So these are very, very specific. Now, what happens is as we provide source and low correlations to the strategies, and that when you call us and we talk, we can explain what all this means in plain man English versus what we're talking about financial English. But what's great about the strategies that we put in place and when the diversification, you can move in and out of each of these legs of the stool. The key is that we always have these 3 legs to meet with your risk criteria. So how's this whole thing work? Well, through our Risk Pro strategy, your pre-retirement solution in the 401k plan, there's no minimums. There's 13 primary strategies and 15 risk-controlled managed models. So there's 28 options that we have here versus what you currently have with your core, and out of these options are really based on, again, what that risk number is that we've assessed in the very beginning. Now, if you have variable annuities or other retirement, we can optimize the variable annuities. Not all of them, but there's a couple strategies that we use with new or existing policies, so that's something that we can look at as well. And then we also have strategies that we use outside of 401k plans as well, to kind of just show a holistic kind of approach. And managed strategy program, so there's additional options, if you will. So now, I just throw this out here so you can see that this is available, just so you kind of have an idea of how we can consolidate, correlate your overall plans. But most of our clients, to be quite honest with you, most of our clients take advantage of this 401k pre-retirement solution. Diving in. Now, here's the interesting thing. Now, we talked about advisor fees and everything. Our fees do not increase your plan fees. Whatever your current plan fees are is what the fees are. We get paid out of the plan that you're already paying fees to. So rather than paying the fees that you're paying now and not getting any advice and not getting more options than what you are through the core, by hiring us, you're actually paying the same fees, but now you're getting all that advice. So it's kind of a win-win for you. So your next step really is to reach out to us, and let's set up a phone call conversation. Let's talk about it. Let's look at some things, and based on that phone call, we can guide you and direct you on what the next steps would be. So again, thank you very much for your time. Again, my name is Robert Wolf with Terra Firma Business and Financial Consultants, and yeah, just reach out to us. Look forward to the opportunity to help you. Thank you so much for your time. Bye-bye.